Hello, I'm Christian Diebitsch. I manage the Heptagon European Focus Equity Fund, and here are my comments for September. European focus fell by 7.4% compared to the MSCI Europe index with dividends reinvested, which fell by 6.3%, so 1.1 percentage point underperformance. Every industry sector fell in absolute terms. There was clearly a defensive stance to what investors preferred. The least bad performing sector was healthcare, it dropped by 4.2%, followed by consumer staples at minus 5.2%, but also deep value sectors like energy and financial stocks, they dropped by minus 5.3% and minus 5.4%. Since there were no corporate results of note, what really characterized the investor focus during September was very much macroeconomics. Of course, inflation data was very important, but there were also a lot of comments made by various central bank heads. The most important, of course, was from Jerome Powell of the Fed. It came straight off the heels from the Jackson Hole summit in late August, where he really clarified what the Fed's intentions are, and that is really two objectives. The first is to bring back inflation to 2%, which is a stated target, and then also to bring back inflation expectations, and that's going probably to take a bit longer. And what Powell is saying, which we totally agree with, is that if consumers and companies continue to believe that investors will run in the long term, it affects households' spending patterns, and it will also affect companies' investment patterns. So really what the Fed needs to do is knock these kind of inflation expectations on the head, and what the market, I think, rightly concluded is that the Fed is very likely to hold interest rates higher for longer. An urgent question is how European companies will cope with the significantly higher energy costs, and particularly now when winter is approaching and the weather is getting a lot colder. Actually, what we believe is that most companies have already addressed the largest part of this issue. All the portfolio companies that we have been talking to, they're clearly on top of things. But to us, it also really depends on what type of business we're looking at. European focus is very strict on investing in asset-light businesses which tend not to be so energy intensive. For example, the fund does not invest in transportation related businesses like airlines, like shipping, any kind of activity which does not involve dependence on petrol or diesel. Secondly, European focus does not invest in heavy duty manufacturing like aluminium production or steel making. It also does not invest in heavy duty type of capital goods equipment or in chemical businesses. Thirdly, the strategy does not invest in hospitality or real estate. For example, when you look at hotels, these kind of businesses, they will need much better planning in terms of heating up of rooms and assessing that versus vacancy occupancy rates. That is totally out of our remit. Our type of businesses tend to be asset light and much more value added in terms of the know-how and refinement of the different products. And that generally means that energy consumption tends to be a smaller part of the overall cost base. And of course that's beneficial now when these prices are going up. 1/4 of the fund is currently made up of healthcare stocks. For example, the biggest position, which is nearly 10%, is the world's largest insulin maker, Novo Nordisk. But we also have medical equipment makers like Coloplast, like Straumann. We also have roughly 1/4 of our exposures in consumer staple stocks. Businesses like L'Oreal and Beiersdorf, which do consumer care products, they tend to be the most energy consuming businesses, but also here they sell a lot on the brand name. Another 15% of the fund is made up of technology businesses. These are companies like Adyen, Dassault Systems and ASML. Perhaps with the exception of ASML, which is the world's largest producer of equipment for semiconductor manufacturing, both Adyen and Dassault Systems, they don't really require much energy. It's really the electricity to power up their computers. But the value added here really lies in the software technology, where energy really makes up a very small part of the overall cost base. So, when you look at European focus, approximately 2/3 of the fund is made up of businesses which do not require a significant amount of energy. So the fund really should sustain that kind of risk quite well. Over the past few years, our portfolio companies, they've been gradually shifting to renewable energy sources in order to align with the Paris Agreement. And more recently, they've been negotiating with their providers of energy to secure contracts which will get them through winter. Secondly, should the current energy crisis become even worse, we're quite sure that most of them, they will negotiate with their employees, perhaps to put in an extra shift and start manufacturing to the degree that they need to do that during night time when the spot price for energy is lower. So there are many different ways to further cut costs if need be. We are approaching the third quarter reporting season, and we believe that this topic will be extremely important for companies to address. These are my comments for September. Thank you so much for listening in. If you have any questions, please contact Heptagon Capital.